What are the best mutual funds to invest in for 2024? With so many options out there, it can be hard to know where to start. In this video, we'll look at some of the top strategies to help you make the most of your mutual fund investments. From focusing on low-cost funds to reinvesting dividends and keeping your portfolio balanced. These tips will help you maximize your returns. Whether you're new to investing or looking to fine-tune your strategy, you'll find practical advice here to grow your wealth. Stick around and let's explore how you can build a strong portfolio for 2024 and beyond. Let's get into it. Diversify your portfolio. When it comes to investing, putting all your money in one place can be risky. That's why diversification is such a smart strategy. By spreading your investments across different asset classes, sectors, and even countries, you reduce the risk of any single investment dragging down your entire portfolio. Think of it like this: if one area underperforms, your other investments can help balance things out. A well-diversified portfolio often includes a mix of large-cap, mid-cap, and small-cap funds. Large-cap funds give you stability, while mid- and small-cap funds offer more growth potential. Throw in some international funds, and you're spreading your risk even further by tapping into global markets. Diversifying doesn't just reduce risk, it also increases your chances of capturing returns from different parts of the market. Whether you're looking for steady growth or higher risk, high reward options, having a balanced mix of funds will give you more opportunities to succeed while helping protect your overall investment. Focus on low-cost funds. You know that feeling when you realize fees are eating into your budget. The same thing can happen with your investments. Over time, the fees you pay on mutual funds, called expense ratios, can seriously cut into your returns. That's why it's smart to focus on low-cost funds, so more of your money stays invested and grows. Index funds and ETFs are great options because they typically have lower expense ratios compared to actively managed funds. With index funds, you're tracking a specific market index, which means less hands-on management and, in turn, lower fees. For long-term investors, this can make a huge difference in how much you earn over the years. Choosing low-cost funds is an easy way to boost your returns without doing anything extra. By paying attention to those fees up front, you'll keep more of your money working for you and growing over time, rather than losing it to high fees that don't always bring better results. Invest in growth-oriented funds. If you're looking for higher returns, growth-oriented funds might be just what you need. These funds focus on companies that are expected to grow faster than the overall market. They often invest in sectors like technology, healthcare, and consumer discretionary, areas that have strong growth potential. For 2024, these sectors are expected to perform well, making growth funds an attractive option. Now, it's important to keep in mind that growth funds can be a bit more volatile than other types of investments. That's because they're tied to companies that are still expanding and may have ups and downs. But if you're willing to take on a little more risk, the potential for substantial gains can be well worth it. By adding growth funds to your portfolio, you're positioning yourself to benefit from industries that are leading innovation and development. It's a way to aim for higher returns, while keeping your investment strategy forward-looking and aligned with future market trends. Utilize dollar-cost averaging. Investing can feel tricky, especially when markets are up and down. But dollar-cost averaging helps take some of the guesswork out of it. This strategy is simple. You invest a fixed amount of money on a regular schedule, whether the market is up or down. By doing this, you're buying more shares when prices are low and fewer shares when prices are high, which can help lower your overall cost. The beauty of dollar-cost averaging is that it takes the pressure off trying to time the market perfectly, which is something even seasoned investors struggle with. Instead, you stay consistent, and over time, this disciplined approach can lead to better long-term returns. It's especially useful for those who want to invest regularly without worrying about market swings. By sticking to a set plan, you avoid the temptation to panic during downturns or chase after high prices. This steady method can help you ride out market volatility while building your portfolio over time. Reinvest dividends. Dividends might seem like small payouts at first, but they can really add up over time, especially if you reinvest them. Instead of cashing out the dividends you earn, you can automatically reinvest them to buy more shares in the mutual fund. Many funds offer this as an option, and it's a smart way to boost your investment without any extra effort. The real magic happens through compounding. By reinvesting your dividends, you're not just earning returns on your original investment, you're also earning returns on the shares you buy with those dividends. Over the long term, this can significantly increase your overall returns. making your money work harder for you. Reinvesting dividends is a simple but effective strategy to maximize your growth potential. It's especially useful for long-term investors who want to keep building their portfolio. The more shares you accumulate, the more dividends you'll earn, and the cycle continues, helping you grow your investments steadily over time. Regularly review and rebalance your portfolio. Over time, your investment portfolio can shift out of balance without you even realizing it, as some investments grow faster than others. Your asset allocation might end up looking very different from your original plan. That's why regularly reviewing and rebalancing your portfolio is so important. It helps keep your investments in line with your goals and risk tolerance. For example, if your stocks have done really well, they might now take up a bigger portion of your portfolio than you intended, which could increase your risk. By rebalancing, you can sell some of those stocks and reinvest in other areas like bonds or international funds to maintain a balanced approach. It's a way to manage risk and ensure you're not overexposed in any one area. Rebalancing also gives you a chance to take advantage of market opportunities. If one sector is underperforming, it might be a good time to buy at a lower price. Regularly reviewing your portfolio ensures that your investments stay aligned with your long-term strategy and financial goals. Stay informed and updated. Staying on top of your investments doesn't have to be overwhelming, but keeping informed is key to making smart decisions. The financial world is always changing, so it's important to stay updated on market trends, economic indicators, and how your mutual funds are performing. Even small shifts in the market can affect your returns, so having the latest information can help you make better choices. Subscribing to financial news, following market analysts, or even just reading your fund reports regularly can go a long way. You don't need to become an expert, but knowing what's happening in the market will help you spot opportunities or avoid potential risks. The more informed you are, the better you can adjust your strategy to maximize your returns. Staying updated helps you identify the best funds and decide when it might be time to shift your investments. It's all about being proactive, so you can keep your portfolio aligned with your goals and make the most of your money. By using these strategies, you'll be well on your way to maximizing your mutual fund returns in 2024. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more investment tips from the Money Blueprint. Stay tuned for more ways to grow your wealth and make smarter financial decisions.